We are entering 2026 with an economic system that is clearly under strain. More than half of the population does not have enough money to invest. Yet asset prices remain near historical highs. When these two forces exist at the same time, it tells us the machine is becoming unbalanced. History shows that systems under this kind of pressure do not stay stable forever. They either adjust smoothly or they reset painfully. This is not a period of comfort. This is a period of decision-making. Pain is likely unavoidable. The real question is not whether pain will occur, but whether you understand how the system works well enough to evolve instead of breaking. Before analyzing individual assets, it is necessary to understand the environment in which the entire system is operating. Markets do not move randomly. They move because incentives change and because money flows through predictable channels. When central banks increase liquidity, the system receives fuel. When they restrict liquidity, the system loses fuel. At the moment, the system is adjusting again. Monetary conditions are no longer tightening the way they were before, and this changes behavior across all asset classes. At the same time, corporate insiders are reducing exposure at one of the fastest rates seen in recent cycles. This does not mean collapse is imminent, but it does signal that expected future returns are becoming less attractive relative to risk. When prices rise faster than fundamentals, the machine becomes fragile. This is a recurring pattern throughout history. If you look back at previous late cycle environments, you will see the same elements appear repeatedly. High asset prices rising alongside growing inequality and declining purchasing power for the majority of participants. This is usually followed by a period of adjustment where expectations reset. Understanding this context matters because it determines how much risk the system can absorb before it breaks. Most investors focus on predictions. A better approach is to focus on positioning. If the system continues higher, you want exposure. If the system adjusts lower, you want survival and optionality. This is why simplicity becomes powerful at this stage of the cycle. Complexity increases fragility. Simple systems survive stress better. This is also the moment where discipline matters more than intelligence. Many people believe that high prices mean safety because prices have been rising. In reality, high prices reduce future expected returns and increase sensitivity to shocks. This is not a belief. It is arithmetic. When valuations expand, the margin for error shrinks. The uncomfortable truth is that the system does not care about your confidence or your optimism. It only responds to flows and constraints. This is why controlling behavior becomes more important than forecasting outcomes. One of the most reliable behaviors to reinforce at this stage is long-term consistency. If you find value in understanding markets this way, and you want to continue learning how these systems actually work, you should like this video and subscribe because it increases the probability that you continue improving your decision-making process. The most important advantage an investor can have is not information, but the ability to remain rational when the environment becomes emotionally challenging. This is where pain enters the equation. Pain exposes weaknesses in systems and in people. If you reflect on that pain instead of reacting to it, you gain progress. This principle applies to markets just as it applies to life. The goal is not to avoid pain, but to survive it and learn from it. That is how systems evolve, and that is how investors evolve with them. When analyzing equities, it is important to separate short-term price movement from long-term system behavior. Stocks are not lottery tickets. They are claims on future productivity. Over time, the equity market functions as a machine that converts economic growth into shareholder returns. In the short term, that machine is driven by emotion, liquidity, and positioning. In the long term, it is driven by earnings and reinvestment. If you understand this distinction, your behavior becomes more rational. During 2025, the equity market delivered strong results despite experiencing significant drawdowns earlier in the year. This is not unusual. In late cycle environments, volatility increases because expectations are high and tolerance for disappointment is low. When prices fell sharply, many participants experienced pain. Accounts declined rapidly and confidence was tested. The key difference between failure and progress is how that pain is processed. If falling prices trigger fear, the investor sells and locks in losses. If falling prices trigger reflection, the investor recognizes that future expected returns have improved. This is where dollar cost averaging becomes powerful. If prices rise, you continue buying and your existing holdings appreciate. If prices fall, you acquire more ownership of the system at lower cost. Either outcome keeps you participating in the machine. This approach removes the need for prediction. Prediction is fragile. Positioning is robust. History consistently shows that attempts to time market peaks and bottoms reduce long-term returns for most participants. This is not because people lack intelligence. It is because emotional pressure distorts decision-making. Simplicity protects against that distortion. Broad market exposure across domestic, international, and emerging markets distributes risk across multiple economic engines. If one region slows, another can compensate. This is how resilient systems are designed. During periods of sharp declines, such as when major indexes fall rapidly, many investors celebrate rising prices and fear falling ones. This behavior is backwards. Younger investors with long-time horizons benefit more from lower entry prices than from short-term gains. Markets rising without interruption create comfort but reduce opportunity. Markets declining create discomfort but increase opportunity. This is an uncomfortable truth, but one that repeats across every major cycle. Over extended periods, diversified equity markets have rewarded patience, not precision. There have been drawdowns, recessions, and crises, but the system adapts. Companies cut costs, innovate, and grow again. Those who remain invested benefit from that evolution. The purpose of this strategy is not to maximize returns in any single year. It is to maximize the probability of long-term success. By consistently adding capital and resisting emotional reactions, you allow compounding to work. Compounding is slow at first and powerful later. Most people abandon it before it delivers its full benefit. Pain tests commitment. Reflection strengthens it. Progress follows those who endure. This is not a perfect system. It is simply the one with the highest probability of survival and growth across uncertain futures. Real estate should be viewed as a system driven by leverage, cash flow, and regulation. When all three align, the machine works extremely well. When they diverge, the machine becomes inefficient. Early in many cycles, real estate benefits from low rates, rising incomes, and expanding credit. Leverage amplifies returns and patience is rewarded. Over time, however, conditions change. Prices rise faster than rents. Debt becomes more expensive. Regulation increases friction. When this happens, the return profile shifts. The same asset that once produced stable growth begins to require more effort for less reward. In the current environment, housing prices are near historical highs while monthly payments have increased dramatically. In many regions, it is cheaper to rent than to own. This is an important signal. When the cost of ownership exceeds the value of usage, capital is being misallocated. From a system perspective, this reduces future returns. It also increases sensitivity to shocks. Real estate is not just an investment. It is an operational business. It requires management, maintenance, insurance, and legal compliance. As prices rise, these costs increase faster than income. At the same time, political and regulatory constraints often limit how quickly rents can adjust. This compresses margins. When margins compress, leverage becomes dangerous. If a system requires constant intervention to function, it becomes fragile. In this phase, selling is not an emotional decision. It is a mechanical one. Capital should flow toward areas where the risk-adjusted return is highest. When that changes, the correct response is reallocation, not attachment. This does not mean real estate is a bad asset. It means that at this point in the cycle, the trade-offs have shifted. For some investors with high skill and strong appetite for operational complexity, opportunities still exist. For others, the cost in time and attention outweighs the incremental return. Time is a finite resource. When an asset demands increasing amounts of it, the true cost becomes visible. This is why concentration in a single asset class and location increases risk. Diversification across systems reduces dependence on any one set of rules. Selling properties at elevated prices converts illiquid leveraged exposure into liquid optionality. Optionality is valuable late in the cycle. It allows adaptation. It allows patience. It allows capital to move when conditions improve elsewhere. Historically, periods of peak enthusiasm in housing are followed by long periods of stagnation rather than sudden collapse. This creates opportunity cost. Capital tied up in low-growth assets misses compounding elsewhere. The goal is not to exit permanently. The goal is to wait for conditions where the machine works in your favor again. Pain often appears when letting go of strategies that once succeeded. Reflection reveals that success came from alignment, not from permanence. Progress comes from recognizing when the environment has changed and adjusting behavior accordingly. Systems reward those who adapt, not those who cling to past advantages. Bitcoin should be understood as a young system operating inside a much larger monetary machine. Its behavior is extreme because its structure is extreme. It has limited history, high volatility, and a participant base that frequently uses leverage. When conditions are favorable, this amplifies gains. When conditions tighten, the same leverage accelerates losses. This is not a flaw. It is a characteristic of the system. In the current cycle, Bitcoin experienced large price swings that tested conviction. Prices moved sharply lower before recovering and then stabilizing. For many participants, this resulted in losses even though long-term narratives remained unchanged. This is a critical lesson. If you enter a highly volatile system without understanding its mechanics, you will likely react emotionally. Emotional reactions are punished in systems that move faster than human psychology can adapt. Several forces contributed to recent underperformance. First, leverage levels were high. When prices declined, liquidations forced additional selling, which pushed prices lower. This is a mechanical process, not a moral one. Second, capital began rotating away from risk assets as uncertainty increased. When liquidity preference rises, speculative assets feel pressure first. Third, after a significant multi-year advance, profit-taking is natural. These factors combined created a perfect environment for volatility. The correct response depends on position sizing. If exposure is too large, volatility becomes intolerable. If exposure is sized appropriately, volatility becomes manageable. This is why small allocations matter. A limited allocation allows participation without risking survival. Using a systematic approach such as dollar cost averaging further reduces emotional pressure. It transforms price movement from a signal to a process. Losses can also be reframed as information. When prices decline, taxable losses can be harvested and used to offset gains elsewhere. This turns volatility into a tool rather than a threat. It is important to acknowledge reality. In the most recent period, Bitcoin underperformed other assets. Denying this provides no benefit. Radical truth improves decision-making. The question is not whether Bitcoin is good or bad. The question is what role it plays within the total system. As a potential alternative store of value, Bitcoin represents an experiment in monetary evolution. Experiments involve failure risk. Allocations should reflect that. Long-term adoption remains uncertain. Regulation, technology, and behavior will all influence outcomes. Because the range of outcomes is wide, confidence should be low and humility high. Systems evolve through stress. Some participants will exit, others will adapt. The asset itself will either mature or fail. The only controllable variable is exposure. Pain reveals misalignment between belief and position. Reflection allows correction. Progress comes from aligning risk with tolerance. Bitcoin rewards discipline and punishes excess. Treated as a speculative satellite, it can enhance a portfolio. Treated as a certainty, it becomes dangerous. Understanding this distinction is essential for survival in volatile systems. Precious metals should be understood as a response mechanism within a larger monetary system. They do not generate productivity and they do not innovate. Their role is preservation. When confidence in paper assets weakens, capital looks for scarcity. This behavior has repeated across every major monetary cycle in history. Gold, silver, and other metals function as anchors when trust in currencies declines. In the current environment, precious metals have risen sharply. This is not random. It reflects increased uncertainty, higher debt levels, and concerns about long-term purchasing power. Silver, in particular, has attracted attention because it sits at the intersection of two systems. It is both a monetary metal and an industrial input. Demand from energy, technology, electronics, and manufacturing increases its sensitivity to economic trends. At the same time, supply growth remains constrained. When demand rises faster than supply, prices adjust upward. This is basic cause and effect. However, it is important to maintain perspective. Short-term outperformance does not equal long-term superiority. When adjusted for inflation, silver remains below historical peaks. Gold, when viewed across decades, primarily tracks the erosion of currency value rather than generating real growth. This distinction matters. Metals protect against loss. They do not compound value the way productive assets do. In late cycle environments, metals often perform well because fear increases faster than growth. This does not mean they should dominate a portfolio. It means they serve a specific function. That function is diversification and psychological stability. When markets are volatile, metals can reduce emotional stress by providing an asset that behaves differently. But relying on them for long-term wealth creation introduces a different risk. Opportunity cost, capital allocated to non-productive assets cannot benefit from economic expansion. This is why metals should be sized appropriately. A small allocation can improve system resilience. A large allocation can reduce long-term progress. The correct question is not whether metals will continue to rise. The correct question is how much protection is needed given the current balance of risks. Extreme optimism toward metals often appears near periods of peak anxiety. History shows that fear-based trades can overshoot just like greed-based trades. This is why discipline matters. Understanding the role of each asset within the total system prevents overreaction. Metals are tools. They are not solutions. They respond to conditions, but they do not shape them. Pain often emerges when investors chase recent performance. Reflection reveals that performance follows cycles. Progress comes from allocating based on function rather than excitement. In a balanced system, metals play a defensive role. They help absorb shocks. They do not drive growth. Recognizing this keeps expectations realistic and behavior controlled. Systems reward those who respect function and punish those who confuse protection with progress. The final component of the system is stability. In every cycle, there is a phase where growth slows, volatility increases, and confidence becomes fragile. During these periods, optionality becomes one of the most valuable assets an investor can hold. This is where high-quality bonds and cash-like instruments serve a purpose. They do not maximize returns, but they maximize flexibility. When a portion of capital is allocated to assets that preserve value and generate steady income, the system gains resilience. If markets decline, this capital provides the ability to act rather than react. If markets rise, it continues to earn without requiring constant decision-making. This trade-off is intentional. In hindsight, holding safer assets often appears inefficient. In real time, it provides psychological and strategic stability. Late cycle environments reward those who remain liquid and patient. Historically, the most damaging losses occur not from market declines, but from forced selling. Liquidity prevents that outcome. Looking ahead, the highest probability scenario for 2026 is not extreme growth or collapse. It is lower returns, higher volatility, and fewer easy opportunities. Systems behave this way when excess has already been absorbed. Innovation continues, but at a slower pace. Speculation decreases. Discipline becomes more important than speed. This environment punishes leverage, impatience, and overconfidence. It rewards consistency, diversification, and humility. No one knows exactly how the next year will unfold. Acknowledging that uncertainty is a strength, not a weakness. When confidence is low, diversification should be high. When outcomes are uncertain, position sizes should reflect that uncertainty. This is how risk is managed rationally. The objective is not to be right. The objective is to remain in the game across many possible futures. Pain will appear in the form of drawdowns, missed opportunities, and periods of boredom. Reflection determines whether that pain leads to poor decisions or better systems. Progress comes from building portfolios that survive stress without requiring prediction. Over long periods, those who endure and adapt accumulate advantages that compound quietly. This is the nature of evolution in markets. The future rewards those who design systems, not those who chase outcomes. The correct response to uncertainty is not fear or excitement. It is balance. When you align behavior with probabilities rather than narratives, you increase the likelihood of long-term success. That is how systems survive. That is how investors progress.